Tomorrow's jobs report, the first so-called clean one since the government shutdown. It could go a long way in deciding the Fed's next move, and investors who are banking on the economy remaining strong. For more, let's welcome in Torsten Slok. He's partner and chief economist at Apollo. It's nice to see you. Welcome back.
Thanks, Scott.
What do you think is going to be delivered tomorrow?
Well, so the expectation from the consensus is that job growth will be 70,000 in the month of December. We think that job growth is going to be higher at 98,000. So we view this, exactly as you're saying, as the first clean reading after some very bumpy months in October and November. Let's not forget that the shutdown ended on the 12th of November. So there is some rebound coming as a result of still November being somewhat suppressed because of the shutdown. But you're right that this is a better reading than what we have for previous months. And we do expect that the number will be surprising to the upside.
So sounds like one that you think is going to only underscore the fact that a cut later this month is unlikely?
Yeah, a cut is very unlikely in January because what was a very significant headwind to the U.S. economy last year, namely the trade war, is now beginning to fade more and more into the background. And instead, we're having a number of tailwinds begin to build up. We have tailwinds very importantly coming from lower oil prices, and what's happening in Venezuela is likely also further going to add more supply to the oil market and therefore more downward pressure on oil prices. That continues to be a positive for the outlook. We also have that over the last 12 months, the dollar is still lower. That's also a tailwind. And very importantly, the AI and data center spending boom continues. And of course, critically, starting on the 1st of January, we now also have the One Big Beautiful Bill. The Congressional Budget Office is estimating that the One Big Beautiful Bill will add 0.9% to GDP growth over the year of 2026. That's a very substantial amount of growth coming purely from fiscal policy. Remember, GDP growth normally is 2, and now we almost have a full percentage point coming because of fiscal policy. So it's getting more and more difficult to be bearish on the economic outlook. So as a result of that, we should begin to see here in the data when we get it for January and February, that job growth begins to respond and become therefore higher in a much more meaningful way.
I'm confused, though, because at least from the notes that I'm looking at, you think the outlook for the economy this year is one that's more stagflationary. Doesn't sound like that's the picture you're painting, though.
Well, but the key issue here is that we're entering this year with inflation already at close to 3%. And now we have had some weakness over the last several months in the labor market. But as that weakness fades more and more into the background, the risks are beginning to rise that we're moving from that stagflationary outlook that most people had going into this year to now turn into instead an overheating outlook where we have both inflation at too high levels at around 3%. Remember, the Fed's target is 2%. And now some tailwinds beginning to build up that as we go through this year will begin to result in higher growth, especially on the CapEx side, where companies now can do 100% expensing of their CapEx decisions this year. Normally, when you do CapEx, you have to write it down over several years, but now you can immediately deduct 100% from your taxes this year. So you're right, Scott. It is indeed the case that this stagflationary scenario is beginning to become more the issue that we had in the last few months, and we are beginning to turn more optimistic on the outlook as we look into 2026.
You're pointing to what very much sounds like a quote-unquote run-it-hot economy. I'm surprised, I guess, too, that you still have a recession probability for 2026 at 30%. I mean, yes, so some may think that that's not that high, but sounds high to me given the environment you're talking about.
So that number is actually the consensus view of what markets are expecting that will be the likelihood of a recession over the next 12 months. And I do believe that that number is too high. Our number is closer to 10%. So that means that we still have the view that the likelihood of recession is surprisingly high when you look at it from a consensus perspective. And yes, that has been elevated for some time because people are still worried about the number one risk to the outlook this year, namely that if AI does not deliver on earnings, if we still have a risk in terms of companies that are not necessarily seeing the significant productivity gains that are priced into markets at the moment, then ironically, AI could both be the biggest downside risk, but it could also be the biggest upside risk.